China and Indonesia are likely to be at the two ends of the current macroeconomic spectrum. The two economies differ on how they manage COVID-19, the extent of impact they have under rising US rates, and how their external accounts behave under surging commodity prices. Such differences make them switch place as a likely underperformer and outperformer in the region. China has fallen from a first-in, first-out haven to a first-in, last-out quagmire against COVID-19 due to the government's insistence on dynamic zero-COVID policy. The month-long lockdown in Shanghai has tarnished investors' confidence on China's ability to achieve this year's growth target and the sustainability of zero COVID. The government responded with getting even more resolute on zero COVID and vowing to bolster growth through stronger infrastructure investment and greater policy supports. That said, outlook on China's macro condition turns binary, in our view, contingent upon the success of the government's ambitious plan. Meanwhile, the nominal yield differentials between US Treasury and China government bonds have closed, weakening bond portfolio inflows into China. The surge in global commodity prices, coupled with slowing global export demand, may also pressure China's current account balance. The weakening of China's external position is likely to exert greater pressure on the renminbi. In our view, Indonesia is in a better position in comparison. While COVID-19 vaccination coverage is still far from widespread, the latest wave of Omicron-driven infections peaked relatively quickly and has so far resulted in far fewer deaths compared with the previous outbreaks. The economy is reopening, reviving domestic demand and foreign tourism. As a major commodity exporter, Indonesia also benefits from the surge in prices of its main commodity exports: coal, palm oil, nickel, and natural gas, among others, helping to offset higher crude oil import costs. Rising US rates and strong US dollar are pressuring Indonesia's external accounts and the rupiah. However, still hefty nominal and real rate differentials with the US, coupled with improved macro fundamentals vis-a-vis 2013's taper tantrum, allow Bank Indonesia to normalize monetary condition at a more gradual pace than the Fed. Rising food and energy inflation are concerning, but the government can tackle them through fiscal and administrative means, reducing the burden on monetary responses.
Allianz Global Investors.